in chapter 9, we talked about the accounts payable ledger. And so in chapter 10, we're going to look at the other side of that, the accounts receivable ledger. And we're going to look at accounting for sales. So accounts receivable, the definition of accounts receivable is legally enforceable claims for payment held by a business for goods or supplies or services rendered that customers have ordered. So people have bought stuff from you, but they haven't paid for it. You've delivered it to them. They're going to pay you later. Accounts receivable are assets to the business and have a normal debit balance, just as a reminder for you there. So the amount a business receives from the sale of an item of merchandise is called the selling price. The amount that you add to the cost of that merchandise is called markup. So when a business goes to buy merchandise that they're going to put into their store for sale, they're going to pay one price for it, then they're going to put a markup on it, and then whatever the cost plus the markup is the selling price. An accounts receivable ledger is another subsidiary ledger that we are going to keep track of all of our charge customers. So in chapter 9, we had the accounts payable ledger, which is where we keep a list of all of our vendors that we owe money to. The accounts receivable ledger is a list of all the customers that owe us money. So when we look at it, we have a list of all the accounts receivable accounts, every customer that has bought on account from us, what they owe us. Those all added together should equal the balance of the controlling account, accounts receivable, in the general ledger, just like we did with accounts payable, doing the same thing with accounts receivable here. So our ledger form for accounts receivable is the blue one up here, and this is our general. So just as a reminder, the accounts receivable ledger, you have a debit and credit column for the transaction, and you have a debit and credit column for the balance. On the accounts receivable ledger, because when people owe us money, that's an asset debit balance, it only has one balance column, and it's debit. So if you remember, the accounts payable one was credit, this one is debit. So when you open that form, you write the name of the customer on the line and the customer account number. And then you do the date and their balance. If there is a balance when you open up this page, you write the word balance on there. If not, you just leave it blank. So let's talk about sales tax real quick, because we all know that we pay sales tax. So you go into a store, you buy something. If it's $19.99, you end up paying like $22 something because you have the price plus the sales tax. So that's what sales tax is tax on the sale of merchandise or services. When you as a company collect sales tax from your customers, you don't get to keep that. It's not money for the business. That's money that goes to the government. So basically, you're going to collect that sales tax from your customers, and you're going to put it into an account called sales tax payable. That is a liability to you because you are going to have to pay it into the government eventually. So it's a liability. Liabilities have a normal credit balance. So looking at our sales journal, we have some special columns here. So like our cash payments journal and our purchases journal, now we have a sales journal. The sales journal is only for sales of merchandise on account. So somebody buys stuff from you, they're going to pay you later. That's what goes in the sales journal. If they buy something from you and they pay you cash, does not go in the sales journal. Only sales of merchandise on account. So our sales journal has 3 columns. Accounts receivable debit to show what they owe us, sales credit to show what the sale was, and then sales tax payable credit. Your 2 credits added together will equal your debit. So a sales invoice looks a lot like a purchase invoice from last chapter. The difference is who's using it. So if it's you selling it to a customer and this is the invoice, then it's a sales invoice to you. On the customer side, it's a purchases invoice. Basically the same thing. They tell who, your name of your company, who you sold it to, has a number up there at the top, tells you what was sold and how much it was sold for, what the sales total was, what the sales tax total was, and what the total they owe you is. So when we do a sale on account, this transaction says sold merchandise on account to Wells Apartments plus sales tax, and they're using a sales invoice amount. So it's a sale on account. Accounts receivable goes up for the total because they owe you the amount of the sale plus the sales tax. Sales tax payable, or sales goes up for the amount of the sale. Sales tax payable goes up with a credit for the amount of the tax. So when you record that, you start with your date. The customer name goes on the line, the sale number. Now notice again, similar to the other ones, the column says sale number. So you don't have to put an S for the sales invoice like we've been doing in the past on the general ledger. It just said document number, so you had to put a C or an S or whatever, an M. Here, we don't have to do that because it's only going to be sales invoice numbers. Then you put your accounts receivable debit, your sales credit, and your sales tax payable credit. And that's pretty much how you record sales on account in a sales journal.